want to welcome everybody to our monthly roundtable. This month we'll be discussing succession matters. I'll introduce the speakers and the topic in a little bit. As everybody knows, we have the chat feature that's up top on your screen. If you have comments, you can put in the chat, but if you have questions, please put it in the Q&A. I generally monitor the Q&A for questions that I will try and ask the presenters as we go along. So try and keep the Q&A limited to chat, the Q&A limited to questions and not chat. As usual, we have polling questions. There are people that do need CPE, and there's a requirement that you get at least 3/4 of the polling questions in order to get credit. So I will send the polling question now just so we can start it off. Hopefully you see it. How often do you think about succession issues? Often, occasionally, rarely, or never, and I'll leave that up as we continue on, but I don't see people. There we go. We do have some people answering. All right, so I know they can see the poll. I know they can hear us, but we've got 2 responses out of the 30 people that are on. So there we go. I don't know if it takes a while. Can you guys see the poll too?
I did.
You can see it?
I saw the poll.
Yeah, I saw it.
And I answered.
Oh, you answered? You were one of the 2 at first.
Probably.
Oh, it's interesting. So I'm going to close it very soon. But right now we have the majority at often, which is good for you guys, and nobody at never, which is really good. So at least we have people thinking about it. 4 or 16% of them said rarely, but the majority is often and occasionally. So we'll close the poll, and everybody knows how the polls go. So as I said, today we're going to be talking about succession issues, particularly a lot related to small business or closely held business succession matters. Our panel today include Monica Caden, who's with Sobel & Company, who will be speaking on valuation matters. We have Jim Apostolico, who's with the IFP Group, who will be introducing insurance matters as it relates to the succession issues. And leading the discussion is Phil Corbo, an attorney with, and he knows I mess this up all the time, so I'm just going to give the first name, Orloff, and he can give the full name. And during the presentation, or at the end of the presentation, we'll have all their contact information. I recommend you reach out to them. So, Phil, I'm 56 years old, and I talk with a lot of people in my age group, which can range from 15 to 80. No, from in the age group, and people are starting to think about it at this time, especially going through COVID time frame. And I have clients that are in the late 80s or in the upper age brackets, and you have clients in the younger age brackets. And you hear a widespread of people when they start thinking about succession issues. As an attorney, how do you answer that question? And then that answer may have changed pre-2020 to how it changed now. But how do you answer that question?
Well, good morning, everyone, and thank you, Brad. So it's a great question. So I'm a trusted estates attorney. I've been with the firm of Orloff Lowenbach for 20 years. And closely held business owners, representing them and their families, that's really the bread and butter of our practice. Really, for all of our business owners, we should start thinking about business succession planning all the time. And it doesn't matter the age. And one thing, Brad, as you mentioned, with what we've been through the past couple of years, one thing I think it's taught us is that life is uncertain. So certainly for the older business owners who are thinking about leaving their business or selling their business and leaving the proceeds to the next generation, older business owners should absolutely be thinking about it. But so should younger business owners. And it should be thought about in connection with really 3 things. There's 3 things we think about when we think about business succession planning. One is control. Who will control the business when it goes to the next generation or the next owner? Another thing that we think about is, how are we going to treat the interests of various family members in the business and outside of the business? And also, the last thing that we really need to think about is, what are the most tax efficient ways to transfer the business, either now or possibly on death? Business succession planning, a lot of times what jumps to mind is, well, what happens when I die and who will control the business when I die? But it goes beyond that too, because you also have to plan for what to do in the event of incapacity. So when you look at it in that context and the uncertainty of life, and unfortunately, having done this for over 20 years at this point, I've had terminally ill clients, I've had clients with dementia, and it's It's not often, but at times, there's the 50-year-old or the 60-year-old client who comes with health issues, and then suddenly they're thinking about who's the heir apparent and who's going to take the business to the next step. So it should really always be thought about. And even for the younger client, there's ways to think about that business succession planning, whether it's transfers of equity, but yet being able to keep that control. You're not necessarily giving up the business or doing anything where you want to be able to direct the course of the business. But even as a younger person, you can keep that control and still embark on that planning.
And it's interesting you say or lead into to support your comment about always thinking about it. Chris Martin and I have a client. He was in his early 40s and passed away. It wasn't COVID, just passed away and was not set up properly. So now there are 3 other partners and the spouse comes in and now you have all of those issues. So that's just control aspects. It's not even the tax aspect we've gotten into. But you mentioned the tax aspects, and I know you're going to want to talk about that a lot. And to make matters even more confusing is we have the lifetime exclusion, which is due to sunset. So it's got to be difficult to plan, not just for today, but in 2 or 3 years from now too, when they're supposed to sunset. And if that's if it's going to sunset,
Right.
But you're planning on the fly, it seems like, and it's unfortunate because you have people like Jim and Monica that she's coming up with the value now, but Jim's trying to put in structures of vehicles that will work, but will that work down the road? So is that always a concern?
It's a concern. So we represent, believe it or not, a lot of closely held business owners that they have a lot of wealth in the business, whether it's an operating company, whether it's a real estate holding entity, but they don't have the liquidity to pay estate tax. So New Jersey, thankfully, no longer has an estate tax. We practice in New York as well. New York has an estate tax that kicks in at a little over $6 million. The federal estate tax exemption, lifetime and death, is currently $12,060,000. But as Brad mentioned, that's scheduled to decrease January 1st, 2026. That's essentially going to be cut in half. So that's something that all business owners should keep in mind when doing their planning, because now it's 2022. I will get phone calls if that law doesn't change, and who knows if it will. I suspect it will change, but we'll see. If it doesn't change, I can guarantee that I will get phone calls in November of 2025 with people looking to want to embark on some planning. The tax aspect of planning is very important. The liquidity issue is a big deal. Jim will talk about life insurance and how life insurance can be used to either deal with estate tax issues or to deal with buyout issues. When business owners come to me, we talk about the control issues first, and then we talk about the tax issues next, because we don't want the tax tail to wag the dog.
Really? So real quick, when the owners come in, is their mindset the other way? Tax first, then control?
Owners come in 2 different scenarios, really. The first scenario that I see a lot is when there's news in the Wall Street Journal about potential tax changes.
Okay.
People will come in. The other time that I see business owners a lot, we represent a lot of families, a lot of cousins in the business together, brothers in the business together, parents. And when there's a dispute brewing within the family, when there's concerns within the family, that's the other time.
Okay.
That I see them.
So I interrupted you, but you said that when they come in, you address the control first and then tax. So if you want to go into the control, it's great.
So on the control front, it's a matter of identifying who the heir apparent is, who's going to run the business and who will manage the business when that next generation of business owners is going to come in and step in. Sometimes there is an heir apparent, sometimes there is not. And every situation is very different. Once you identify that, or you put a plan in place, a management structure or a potential management structure in place, next you can deal about the transfer issues. Now, younger business owners a lot of times are reluctant to start transferring those interests. But as I mentioned before, there's ways to keep control and transfer equity. And Monica will talk about, I'm sure, the best way to get valuations on those transfers, whether it's a gift or a sale. But basically, in maintaining that control, what the business owner can do, if it's a corporation, you could recapitalize it into voting shares and non-voting shares. You can keep a small percentage of the equity for voting control and start gifting or selling the non-voting interests to family members or to trusts for the benefit of family members. That aspect of the control and those types of transfers, keeping that in mind, fits then right hand in hand into the estate and gift tax planning. Because in making those gifts, in making those sales, and it's usually to trusts to do it in a tax efficient way, to keep it out of people's estates for estate tax purposes, the value of what you're giving in a minority held business is much smaller because you get discounts for lack of control. If you only get a small piece or no vote, you can't direct when distributions are going to be made. You can't direct the direction of the business, and lack of marketability. There's no market for my widget company that's owned by my family members. There's no exchange that I can go and I can readily sell my shares in the company. Or there could be a shareholders agreement that might even restrict me from being able to sell shares in the company. Because of those restrictions, what might be $1 of value on paper, if you look at a balance sheet or you look at the business as a going concern, it's worth something less because you really can't do anything with it. And by taking advantage of those discounts, it's a way to leverage what people have of that current $12 million federal estate tax exemption.
So as it relates to valuations, Monica, when you get called in, are you generally called in by the attorney or are you called in by the family?
It's usually by the family, but they are in touch with their attorney. They've been advised by their attorney. We're usually dealing with an attorney. So it's usually the family who actually initiates, but they have an attorney they're working with. So
So, and I wanted the attendees to understand what the general protocol is. I don't want them sitting back and they go to Phil and Phil's like, well, what valuation person you use? And they're like, I don't know. I thought you hired them. But so they're usually in contact with you directly. Now, Phil mentioned discounts, and we've always heard that for years. And a general question, not relating to discounts, but as it relates to valuations, has your job gotten harder now with the VCs and how much money they're throwing around with coming up with values of companies?
that's an interesting question. I mean, theoretically, there is a lot of private equity activity. And I think, that leads owners to have expectations that they're going to get a certain multiple, because they hear this, they're reading, what are the multiples? I do a lot in the healthcare space, 8 to 12 times EBITDA. And, I think that, if that's a realistic buyer for your company, then I think it's reasonable to think about those multiples. But I think you really have to think about your company, how it's operating. And, I have a lot of situations right now where it's a company, the buyer is a company in the same industry as the target. So it's not necessarily private equity. I mean, I'm seeing private equity deals, but I'm seeing a lot of deals that are not private equity deals. And in that case, you have to think about your company's cash flow, your profitability, your growth, how you've been impacted by COVID. So there are a lot of factors.
So we usually with the estate planning, Phil and Jim and Monica, you can tell me if I'm wrong, I'm just a knucklehead accountant, but usually you're trying to come up with a lower value. And these people are hearing all these high numbers, and it must mess with your planning when you're trying to come up with a realistic and legitimate, supportable lower number or reduced number. But that's why I was saying the VCs are throwing out these crazy values now.
Well, I think something that owners should think about is that, you're correct, Brad, in that for estate and gift, you want low, right? But if you're selling, you want high. Sure. So if you do an estate valuation today and we value your company at $8 million, and then next year you sell it for 35 million, there may be a look back. It wouldn't be unreasonable. The IRS is going to see we'll see two documents related to your company. So the gift valuation could be questioned. So I think you want to always do something reasonable, but that, we can go to a certain point with gifting to try to get that value as low as we can, but it has to be supportable. And I don't think you want to turn around the next year and sell it for 5 times what we valued it for the gift.
Right.
So
Phil, you were talking about, the valuation as it comes into this, and you work a lot with trusts as a vehicle. And affording this, or the trust, I guess, paying for the stock, how is that that mechanism usually work? What's the vehicle? Does insurance come in, or is that as a life insurance component mainly?
So sales to trusts, technique that's commonly used is a sale to an intentionally defective grantor trust, which it's just a fancy expression for a trust that's disregarded for income tax purposes. So when an owner sells to a grantor trust that is treated as a grantor trust with respect to that owner, there's no capital gain on the sale. And the way that mechanism works is basically the owner will fund the trust with a little bit of seed money, will sell the interest in the business to the trust and take back a note. And then the cash that the business throws off will be used to service that note. So a lot of my clients will say, oh, so I'm going to sell my stock to a trust for the benefit of my kids, and I'm going to use my own money to pay for it. It's kind of how they look at it. That aspect of it doesn't necessarily use life insurance. Where we see the life insurance come into play is with buy-sell agreements, whether it's a corporation or whether it's a limited liability company. We represent a lot of families and also unrelated third parties who own businesses together. So 2 owners of a company, unrelated, may be very happy. They could be younger. They're operating their business. They're doing great. But if one were to pass, the other might not want to be in business with the decedent's spouse or with the decedent's children. So that's a classic example where life insurance will come into play in connection with business succession planning, is with that type of buy-sell agreement. So there's a funding mechanism for that buyout if and when it were to occur. Another place where life insurance comes into play that you'll see is, as I mentioned earlier, for liquidity, for estate tax purposes. And the final aspect where I see it, and I see it a lot, there's just about every family that comes in here with multiple children. There's going to be children who are in the business, love the business, want the business, and then there's children outside of the business. And as I mentioned, no situation is different. There's other things that you can do, but life insurance is a great way to take care of the children outside of the business and who might not even have any interest or ever want to be in the business. They're perfectly happy with the cash on death rather than an interest in the business. So that's the other aspect where I see life insurance.
So that's what I had figured, that you couldn't have life insurance while it's still alive. But when you're transferring the assets to the trust, and there's a note that the trust is paying out to buy the stock from the owner, I guess that's it's set up. But should there be a passing before there's full satisfaction of the buyout, that's where I guess insurance should be set up properly to make sure that it's fully funded. And Jim, like I asked Monica, how are you generally brought into this aspect? Is it by the client or is it through the attorney relationship?
Usually it's through the attorney relationship along with the accounting firm.
Okay.
You guys do a very good job of putting the plans together. Monica, in evaluating what these businesses are worth, and then we just present to the client, here's different avenues, different products we could use to pay for this debt. And insurance is one of the few assets that are income and estate tax free if set up properly. But I am guided by the accounting firm and the attorneys as to what amounts the families are comfortable with. And then we talk to the families about what this is going to cost. And usually you're paying a high cost with very discounted dollars if they're in good health and things are, properly work out and they're younger. I mean, sometimes I get clients, they wait till they're 85 before they're coming to me. And it's tough at 85 getting somebody insurance. I mean, it could be done, but it's not as advantageous as if they were 55 or 60.
And it's because I asked Phil the question, open it up, and wanted to see if you had a contradicting answer, because I could see you guys fight then, insurance and attorneys fight. But is there the best time for somebody to come? I imagine somebody getting an insurance policy at 20 years old when they're very young, but who has the money to do it then? Is there an opportune time to look into insurance?
It's usually middle age is the proper time to get it. And if obviously the perfect time is if you're in good health. And today's kind of amazing. Underwriting has really changed. They have something called the prescription database. And if you're ever sick, you get a prescription. So the insurance companies, where in the past they would not even see something like this in the medical records, they find it everything today. And with COVID, it makes underwriting a little bit more challenging.
So they could see everything that you were trying to hide, and you tell them, no, I'm not a smoker. No, I've never had anything. And now they're able to see everything. But again, going back to my question of when should they do it, they shouldn't be doing it at 20, like we were saying, because you don't know what you're going to have at that point. Usually around the middle age, early middle age, if you're in a family business, what your intentions may be. And as your comment, that's what they should be looking into. I have a client that I was working with in his late 50s, early 60s. He started looking at insurance and he was shocked at the price. I'm like, that's what happens when you former smoker, when you waited that long.
Right. But even the individual in their 20s, if they take out term insurance, it's very inexpensive. And they could always convert it, so they're guaranteeing their insurability, meaning if their health changes in the next 10 years, they can convert it no matter what their health.
Mm-hmm.
So there's different products for different ages, is I guess what I'm saying.
Now, Phil, you had mentioned before control and tax. We can keep talking about for a long time, and the tax people, I'm sure, are like waiting to hear more about tax. And if somebody came to you in the 50s or whatever, they came to you and they said, "Here's my intentions," does that change very often? And does that make it difficult for your planning strategies? I'm not going to give it to this person, or we're going to change our thought process. We're going to sell. Does that make it difficult?
Does the client's change in plans make it difficult? Yeah. The answer is yes, it does. And, some clients are more difficult than others, and some families are happier than others, but I can tell you there's issues everywhere. My typical client meeting with the first-time client, I ask about health and the family and relationships and marriages, and in the first 10 minutes, everything's great. 45 minutes later, we find out I don't like my son-in-law, who has a substance abuse issue. Once people get comfortable, all that kind of stuff comes out after a little bit. Some clients don't change. Some clients are very consistent. Some clients early on with the tax planning and the business succession planning, they want to do very little. I have very wealthy clients who look at the exemption now at $12,060,000, and I tell them that it's supposed to sunset under current law, and they astutely say, well, it's only gone up since I've been around and looking at this, so I'm not worried about it. And for the most part, it has only gone up, and they're right. And they don't want to do the planning, notwithstanding my encouragement. But beyond those kinds of things, families change and situations change. And, my favorite child today is not my favorite child 10 years from now. Who's in a bad marriage? I see a lot of children of business owners who have substance abuse issues. And when they first come to see me, those issues aren't there. And then 10 years later, they're there. So things change. It makes it harder. And here we go back to control when we think about those kinds of issues. So while the business owner's alive, You can fund trusts. Trusts are great things. We can build all sorts of flexibility in changing trustees. We can give equity to the trusts. We can sell equity to the trusts, but yet the business owner can maintain control. And the business owner can keep that control until death. And then on death, through their will or whatever estate planning mechanisms they have in place, they can determine, kind of at the final stage, who will control. And people are different. Some people figure, when I'm gone, my spouse will figure it out. My kids will figure it out. I don't want to give that kind of direction. That might work in some situations. In other situations, it won't. Then I have other clients who really want to have what we call that, quote, dead hands control. They really want to put in major restrictions on what people can do with the business, when to sell, all different kinds of things, which generally I try to talk people out of going too far on that because, life is uncertain, businesses change, circumstances change. But to answer your question, it can be harder. And we specialize and deal with complicated family situations. And at times it's very, very hard to manage. I could give you examples of, I had one in the past couple of years where client had 4 children. One of the 3 was in the business. He was in the process of a little bit at a time transferring equity in the business to the one child who was in the business. 6 months later, a dispute between father and son that had been brewing for years came to a head. Son bought out father for the remaining interests in the business. So things do change. I have another business owner a couple of years ago, 60 years old, bought out his cousin, 50-50 interests in the business over the summer. In the fall, he was diagnosed with terminal cancer. He passed in January. So I guess that's a good example of, 60 years old is pretty young, but clients that I see a lot of times. In the process, that was part of his business succession plan. As part of the buyout, he had identified which of his children was the heir apparent. Everything was in place, but unfortunately, who knew that we would have to deal with that business succession issue so quickly? And thank God he did it.
So I just have to put up a polling question, but Jim, as it relates to changing, let me just see, what's your biggest concern about, now this isn't for you, Jim, this is for the polling. What's your biggest concern about succession, where to start, when to start, most efficient strategy or not applicable? So people can make sure they answer that. So Jim, as it relates to the changes, how do you plan for this and unwind it if you have to, or do you set it up that if it has to be unwound, there's tripwires that can move things around? Insurance to me is not something that's, oh, I'm going to have this today and tomorrow I'll have a different policy.
Right. Flexibility is key. There's sometimes you're limited in what you can do with it, but I'll give you an example. Last 2 years ago, when everybody thought the estate tax laws were changing, we went out and probably sold a lot of term insurance because it was inexpensive yet convertible. It was a wait and see scenario. Let's buy some term. It's inexpensive. It covers you. If the laws change, we can convert it. If they don't, it's not a high cost out of their estate that they used, and it did protect them in the process. So flexibility, it's a great question, is key. I'm always open-minded and take people like yours or Phil's advice as I don't know what's going to happen with tax laws. The same thing I always tell clients, if you tell me when you're going to die, I'll tell you what kind of policy to buy. I don't have a crystal ball, but I do try to make it flexible.
And I guess that's why everybody here works as a team. You have to work as a team because one of you have a little bit of insight as to the nuances of the family structure. And because to Phil's comments before, you could have disputes arising that you may not have known, but somebody knew because they heard over dinner how another person was unhappy, type of thing. And it's important to have that information just in case something happens. And Monica, I don't think that this generally affects the valuation aspects, the dispute. unless maybe control and management could affect the valuation of the company.
I've listened to Phil, and I've been doing this 26 years. And the biggest litigation cases tend to be family cases and divorce cases, but also not divorce cases, just families, unfortunately, that have built very successful businesses. I've been involved with a very large case right now, an amazing immigrant family. I don't want to give the details in case, people know, but very excellent businesses, real estate, stores. And it's horrible to see. But it's real, and you can see, because sometimes it starts with one generation. I'm sure Phil has seen this, and then as it goes down to the children, or then the cousins, the fathers started it, and then you got the first cousins, and at some level, sometimes we see these issues. Valuations, in these situations, sometimes we can be joint. If both sides agree, they're going to hire one appraiser, and it can save costs. But more often than not, one side has a valuation done, the other side has a valuation done. And hopefully you can, you try to mediate and not go to trial. The other thing here, and we're doing this now, is in situations where we do have children in the business, and we have, let's say, a daughter. We have sons in the business, but there are two daughters not in the business. But the family, those daughters, they're trying to allocate equity so that it's equivalent equity. Maybe the sons who are in the business might have some control, management, but the sisters have equity in the business, and I think that sort of planning is wise planning, because you just don't want the situation where, let's say dad dies, sons get the business, they're 50-50, and the daughters are out, and there's been nothing set up that the daughters have received anything. The sons get this business, hopefully it's good, but the daughters are excluded. So I think thinking about those things, trying to be fair to your children, don't leave a situation where you've died and it opens up a fight. So it's almost being thoughtful to the next generation that it should be a peaceful transfer. So yes, certainly a lot of our work is, we've had litigation, but I think we're doing more, obviously, gifting and people just planning ahead. And okay. I think that's the goal of today.
Phil, you mentioned a lot, you said it a bunch of times, and people answered that polling question, not when to start or where to start, but the strategy is the most important to them. And it sounded to me like a lot of it, assuming that there's heir apparents, that trust is the main vehicle that you would be using as it relates to the family business. Is there a particular design of the trust, design of the trust that people should be thinking about?
So a couple of things on that. There's really two primary reasons why we use a lot of trusts in our estate planning and with the family businesses. One that comes to mind, we mentioned already, it's estate tax protection. Put the interests in trust, keep it free of state estate tax if you're in a state where there is a state estate tax, and certainly federal estate tax. And now with the generation skipping transfer tax and rule against perpetuities, and I'm going into legalese now, but there's ways that you can keep those interests in trust now forever, and barring some dramatic change in the law, not ever be subject to estate tax. The other reason that we like to use trusts a lot is for creditor protection. And we say creditors and predators. So whether it's a business creditor or whether, God forbid, a family member runs the school bus off the road, or whether it's a marital creditor, trusts can be used to protect from bad marriages, from all sorts of different creditors. There's different types of trust, and within the past year, there's been threats to changes in how trusts are taxed. Those trusts are still out there, so really you need an advisor to help you stay on top of changes in the law. But a commonly used technique in gifting to trusts that I had mentioned before is a grantor trust, which is a disregarded trust for income tax purposes, which means that a business owner can sell to a trust that's a grantor trust, not incur any capital gain on the sale. And another reason why estate planners like me historically have loved to use grantor trusts, because it's disregarded for income tax purposes. If the trust owns an interest in the business and the business is throwing off income and the trust has income, whether it's ordinary income or capital gain as a result of the business owner get to pay the tax on the trust. And you might think to yourself, well, why is that a good thing? Why is it good if the business owner can pay tax on a trust that's really benefiting some other family member? Well, the reason it's a good thing is because for wealthy business owners, paying that tax, paying that income tax liability each year, it's a good way to make a tax-free gift to the trust each year. So for example, if there's a $100,000 tax bill for a trust for the benefit of child, and that trust is a disregarded entity, that it's all taxed to the owner. When the owner pays that $100,000 tax bill, there's no gift tax. There's no gift exemption used. It's a total, complete freebie. It's such a good deal, which is why that's one of the reasons it's been on the potential chopping block for years, that Congress is looking to chop it. It was threatened in the last potential go around. But thanks to Senator Manchin from West Virginia, he put a stop to it. Whether it'll rear its ugly head, that strategy going away, whether it'll go away in the future, we don't know. But that's certainly one of the types of techniques that we use where we can really be extremely tax efficient.
Diana asked the question, what about a CRUT trust? I don't know if it's applicable.
So CRUT is a charitable remainder unit trust. There's CRATCH, charitable remainder annuity trust. There's all different variations on that technique. Those techniques work. They're very good and they work. But the key to that, for them to work, is there's an interest rate play that you need to figure out. But really the main component of that, to use one of those techniques, is the client needs to be charitably inclined. If you have a client that's charitably inclined, that they really truly want to make the gift, want to do something, and then also have this business interest or other interests that they might want to plan with, then you can start jumping into those types of techniques.
I was going to ask later on about charity, but she beat me to it because we do have a lot of nonprofit people. I don't know if Diana's nonprofit people who attend these, and I'm sure they've been waiting to just hear somebody say, give to charity, give everything to charity, life insurance, everything, give it all to charity. So you're working with the trust, and I know that there are life insurance trusts that generally get set up. And one of the things that you said before, what if there is no heir apparent? Because we talked about family disputes and control. And we've seen a lot now. We're seeing it with second generation not wanting to take over, third generation not wanting to take over. And here come the venture capitalists again. What happens in that instance when there is no heir apparent?
So it's challenging, and it's depending on the family, it can be very challenging. A lot of business owners, they identify with the business. They are the business. And when there's no heir apparent, you can say to them, okay, well, now how old are you? You're 70, you're 80. Now it's time to sell because you don't have an heir apparent. And then they don't want to sell because they say, okay, great. If I sell today, what am I going to do when I wake up tomorrow morning? So that can be a challenge unrelated to the finances of it. But the short answer in that situation, and sometimes the easiest answer, and we've made that recommendation to clients based on the family situation, is you should think about selling. Short of that, it's really a very long discussion, and it's really a process with the client, sometimes with the family, in putting a control structure in. So what we've done at times is we've funded revocable trusts, that we've had the business owner fund a revocable trust where the business owner is the sole trustee. And then when the business owner becomes incapacitated, no longer wants to run the business, we put in a structure. Maybe it's a voting structure. So maybe there's 3 family members in the business and someone outside of the business, an independent trustee who has to be in there to vote with. We've done weighted voting. One family member gets 2 votes, the other ones all get 1 vote. But it's really, when you get into those types of more complicated planning issues going forward, it's certainly not one size fits all. And it's not, okay, come in, sit down, meet with your estate planning attorney. We're going to figure it out in an hour and a half.
Right.
Families are complicated. So it's really a process.
So the difficult thing that I've seen when people don't have an heir apparent and don't want to sell, we actually see this a lot with accounting firms. It's unfortunate. I try and tell people your firm isn't worth as much when you pass away. So
Nice.
Consider beforehand. Okay. You hate talking with friends like that, but you have to be honest sometimes with them. But Jim, what I see happen a lot is somebody will pass away and still have ownership of the business, ownership of real estate. And all of a sudden now there's an estate tax that they're in panic mode to sell the business to fund the estate tax. And I'm imagining you've been sitting here waiting to say, this is why you should have life insurance to help fund the estate taxes.
Exactly. It's a very inexpensive way to create liquidity when it's needed. The worst position a business owner can be, and you guys have all seen it, is they have to sell this business to pay taxes. You're going to pay it, probably sell it at a discounted rate, the business, so the heirs aren't going to be happy, and they're paying a tax that they most definitely did not want to pay.
And the difficulty I see, family members, we keep bringing this family dynamic in. If we didn't have family involved in the estates, it wouldn't be a problem. But they hear that there's life insurance, and you try and explain to them, no, wait, this life insurance is for the estate taxes. Well, we don't want to pay estate taxes. Well, nobody does, but you have to make sure that it's funded. Well, that life insurance is for us. No, first let's make sure the government's covered. Now, is there a special vehicle or way it should be set up, either through you or with the attorney, to make sure that it's funded properly?
That's usually, I pass that one off to Phil.
The-
He's the one that's going to tell them, listen, you're going to have this tax due. This is what we're using the insurance for. And when that time comes, the insurance isn't for your benefit. It's to give you your estate much wholer by doing this.
Okay. And Monica, I want to ask you one quick question, but let me put up the next polling. It's next to last. What is your primary goal? This isn't for you, Monica. This is the polling. What is your primary goal in succession planning? Reduce my taxes, set up for the next generation financially, avoid disputes among beneficiaries, and assist in business continuity exit strategy. So and Phil, I asked you earlier, what do they come in with first? I would have thought people saying to reduce taxes, but you focus with control. So Monica and Jim, I can't imagine that this moving target is easy, because I've listened to what all three of you have said, and children A are getting the business, but children A and B are getting the business, but B and C are not. But you want to make sure that the estate is split up 25% per person, or we have to make sure that there's no heir apparent, but we need the insurance to cover the estate taxes. So we need to make sure we understand the value of the company. And how often should you be getting a valuation done on the company? I know, Monica, you and Becky right now are saying, have a valuation done every 4 months, and we'll charge for that. Put you on the subscription plan. But
Right.
honestly, how often do you need a valuation done? And should Jim then be saying, okay, we have to change the insurance and up it or low it? Or Jim, do you just say, listen, we're going to go with this amount and stick with it? But Monica first, how
Right.
often do you think?
I think there's usually some sort of event that's going on or being considered that usually initiates getting a valuation. People don't usually just get a valuation unless they're looking to maybe sell their company. They've been approached by other companies. And then with estate planning, certainly, I do think, we are seeing owners probably in their 60s who, if they've never had a valuation done and the company's going to be ongoing and they want to make gifts, I would say, mostly I would say clients in their late 50s, 60s are starting to get valuations. And if it's for insurance, um, um, and we're certainly not doing yearly valuations, for insurance purposes. Maybe it's done if there's this initial setup and there's going to be insurance and we do a valuation. Certainly, if the company has changed significantly from when it was first valued, let's say it's grown, revenues have grown 50%, or you're up 10 million in revenues, and the company is a different size and would be valued very differently, you would want to do an update. There might be something in an agreement, a buy-sell agreement, that says when it should be updated. Other times in a buy-sell agreement, let's say we do a valuation, there's going to be insurance, there's a buy-sell. It might be formulaic. We may determine a formula that might be reasonable. If we do the valuation, we can come up with some sort of formula. And if the company doesn't change too much, that formula can hold for a few years. So I don't think you're tied to a yearly valuation. I think you might be, when you start the process, at least for gifting or estate, that's when we would start.
And so, Jim, I mean, I always think, and this is probably my naivete, you thought you buy insurance when you're 20, 30, 40 years old, and you buy the one policy. I mean, when my father passed away, he had a policy for $6,000 that he bought in the 1960s. I don't know what that was going to afford when he passed away in the 90s, but that's what you thought, is that you buy this one policy for this amount, and that should be good. Well, things change over the years. So should you be altering your policies so that the payout changes?
Yes, you need to review policies pretty often today. Again, there's an array of products out there that can actually prematurely expire. And what I mean by that is, it was meant to go to 100. Interest rates have changed. The product's only going to 85 right now. So, and you're seeing that with policies that were sold 20, 30 years ago. And it's a real problem, because at 85, you're not going to have many alternatives or other choices. So initially, when you're buying that product, you want to make sure you know exactly what you bought and how it's going to perform for your estate plan. If you bought a product that's guaranteed, you're just really looking at the state of the company, whether it's still financially secure or not. But there's a lot of flexible products that were sold out there. They can be complicated. And I always tell a client, if I don't understand this, and I'm doing this 38 years, I don't think it's something you should buy. And I say it every day.
So are you talking about Bitcoin right now? I'm not too sure what you meant. No, I'm joking. Any financial person I talk to, stay away from that. Different topic though. So that's one of the things that I've also seen. I had a client that the son passed away and the mother was beneficiary to his insurance, and before anything can happen, she passed away and he was beneficiary to hers. And I'm not laughing at it, but the insanity of it, that I noticed that people don't change or update wills, trusts, if you can, I guess if it's revocable, Phil, you change the trust, insurance, beneficiaries and designs, valuations. Is updating of the essentials critical? And you know the answer, but I want you guys to speak on it.
It's a great point, and I see it all the time. They don't update the beneficiary. They don't update the ownership. And all of a sudden, there's either a terminal illness or a death, and then they're dealing with a problem that could have been easily solved if they just, updated it annually, semi-annually, or every 2 to 5 years. But some people, they put that policy in a drawer and they never pay attention to it again.
Well, most people don't. A lot of times people don't know that somebody had a policy until they're cleaning out the house too.
Right. I get a lot of those phone calls.
I mean, Phil, I'm sure that you've seen this, and I think Jim said about ownership of the insurance. The way, if it's not designed properly, the insurance could be included in the estate value too, right?
Yeah. So when first of all, we recommend for our clients, you really need to look at your estate plan every 3 years or earlier if there's some life-changing event, a death in the family, a marriage, a divorce. And we look at life insurance. Certainly when a new client comes in, tell people if it's a whole life policy, some variation of a whole life policy, we recommend contact your insurance agent, get an in-force illustration. We look at the beneficiary designations. We also look at the owner. Part of our bread and butter estate planning practice is funding trusts with life insurance. If we get it into a trust, we can keep it out of the estate for estate tax purposes. So we're always looking at that and reviewing that when we're looking at an estate plan and updating an estate plan. And one other thing that Monica touched on, I wanted to touch on with valuations for businesses. When we do any kind of gifting or estate planning for businesses, whether it's a gift of a business or a sale of a business interest, we always go out and we get a valuation for it. The reason for that is because even for sales of business interests to family members or to trust for family members, we report those sales on gift tax returns, even if it's not a gift. And the reason to report it is to get your statute of limitations running. There's what are called adequate disclosure rules in the Treasury regulations. So if you report a sale or a gift on a gift tax returns and you adequately disclose how you came with the value, and part and parcel of that is getting Mana to give you a good valuation which lays out exactly how that value was derived. Once you file that return and you report exactly what you've done, the IRS has 3 years to come back and challenge that return. So if you do your gifting now, you do your sale, you report what you did on a gift tax return, and then suddenly Amazon comes in 4 years later and buys your business for 10, 20 times what you gave it for, which is sold it for a few years earlier, you're home free on that. So in terms of timing and when to do valuations, whenever you do any of that kind of gift planning, that's when we always go out and we get them.
Okay. So I have one more polling question and we'll get, excuse me, to the wrap up stage. Have you used insurance options as part of your succession planning? Sorry, yes, extensively, yes, partially, no, and not applicable. That wasn't to you, Jim. So there's still a lot more information that we can go over because this is a 1 hour session, but this is not a 1 hour, let me run into any one of your offices and get all my estate stuff done. As you said, there's a lot of considerations, Phil, of control. There's control of, I have the spouse, but if I pass away, will my spouse be able to still get distributions, or how will they be treated after my passing? And that's why I see a lot of older people retain what they should be getting rid of because they fear they're not going to be able to survive. I had a client with an enormous estate, and I said, why don't you gift some or figure out how you're going to do this? And they said, how am I going to survive? It's like, okay, you have $40 million. I think you can survive, but that's their mindset. So this is not something that people should just say, oh, in an hour I could figure out my estate. They need to sit down and talk with the people like the three of you. And to your comment, Phil, about a qualified valuation, don't just have and I'm not picking on controllers or accountants, don't just have your controller accountant just come up with some sort of value. The EBITDA times 4. That sounds good. What's the basis behind that? So make sure you have, using qualified.
I'll just throw in, Brad, that, the people out there should know that valuation analysts should have credentials. So, and there are numerous ones. You're not limited to one, but there's the American Society of Appraisers, the National Association of Certified Valuation Analysts. The AICPA has the ABV credential. So you want to make sure that whatever appraisal you're getting, the person who's doing it has valuation credentials that are recognized. And there is a format that we follow. And so I'm here at Sobel. We're an accounting firm, so I do follow the AICPA's rules, and I am an ABV, and I have some other credentials. But it is very important that you have a credible, supportable appraisal. So,
And I'm sure the other professionals are looking to that to support their filings, support their insurance decisions too.
of
Right.
course.
So we're at 9:26. As I said, we'd like to get this done around an hour. So I'd like to go to you for any closing comments that you think you'd like to say. It could be just good luck or some parting words. So Phil, since you started us off, I'll let you go first.
So first of all, thank you, Brad, for inviting me to participate. It was a lot of fun. And thank you, Monica and Jim, for your great comments. My parting words are with what Brad started with, it's not too early to start planning. Families are different. Business succession planning, it's not one size fits all. It can be very easy. You might have a happy family who does. You might have a happy family and it could be very easy, but it could also be very complicated. And balancing the interests coupled with the estate planning can be challenging. So start early, and certainly if you have any questions, reach out to me or any one of us. And thank you so much for attending.
Great. Jim?
I want to thank Brad for inviting me here. Monica obviously is very qualified. Phil, I've worked with in the past, so I know he does excellent work. I'm just going to ask a question I always ask my clients at the initial meeting is, you died yesterday. What happened? So it's never too soon to at least explore your options. And I'm sure Phil, Monica, and Brad are the same as me. It's not costing you a lot of money to explore your options. It might be costing you some time, but it's definitely worth it. And thanks for having me.
That's a great way to put it, Jim. You died yesterday. What did you want to happen? Yeah. And now you have it set up that way. Never thought about it looking that way. Look in the rearview mirror to look forward. That's great. Great. Monica, please.
One, I just want to thank everybody for waking up and having coffee with us. Evaluation is not difficult to get. It's 3 to 4 weeks to turn it around. We give you a fixed fee. We're going to look through several approaches. You'll have a better understanding maybe of your company and the value, which could be exciting to you. And it's not a difficult process. And if you're a client of Sobel already, a lot of your information is here. So we don't even have to bother you so much because we have a lot of information internally already. And I thought this was great. I really enjoyed hearing Phil and Jim. I've learned a lot myself today. And we look forward to working with everyone at some point.
And you're not going to believe this. One question just came in. They said they put it in the wrong spot. And I'll just ask what it is because it could probably be answered pretty quick. Last famous words. Sunset was mentioned but not explained. Time permitting, could this be explained? So I think he's talking about the sunsetting of the estate tax, the lifetime exclusion.
Yeah. So the sunset is a short way of saying that the current $12,060,000 federal estate tax exemption, sunset is when we talked about when that exemption at the end of 2025, starting January 1st, 2026, when that 12 million will get cut in half. I can't tell you exactly what it is because it's indexed for inflation, but it'll essentially be cut in half January 1st, 2026. And sunset is the expression we use for that change in the law that's already on the books.
You know what I'm surprised of? Las Vegas has betting and pools on everything. How come there's no pools on or betting what people think is going to happen to the, not just the state laws, all tax laws? I don't know. Maybe it's illegal. I may have just recommended something illegal. Connie, can you delete that? But anyway, Phil, Jim, and Monica, thank you very much for taking your time to do this. I know it's a lot for you to get up and talk about this stuff. So thank you. Hopefully everybody gets your contact information, reaches out to you, and you can give them the best advice and direction. So thank you again.
Thank you all.
Brad.
Thank you.
Bye.
Have a great day.